Hello and welcome to this session in which we look at accounting for natural resources and intangible asset. Actually, I'm going to only do natural resources. In the next session, I will do intangible asset. We'll separate the topics. So what are natural resources? Natural resources consist of standing timber and underground deposit of oil, gas, and mineral. Simply put, what are natural resources? Their distinguished characteristics are their physically extracted in operation. We take them out from the land, and they're replaceable only by an act of nature, or they say act of God, depending. Some people don't believe in God, so they say act of nature. So that's how natural resources are replaced. So just like with any asset, when you acquire natural resources, you have to determine the cost. What's the cost of the natural resources? The cost is the price needed to acquire the resource and prepare it for its intended use. Now that's all what I'm going to tell you here. That's the general rule. I always say this is a financial accounting course. If you want more details about this topic, go to my intermediate accounting channel where you can find little bit more details about this topic. But all what you need to know, the price plus any cost necessary. So let's take a look at an example to see how this works. Well, and remember, natural resources, we pay a cost for them. Then after we pay the cost, we're going to deplete them. What is depleting them? Depleting them is the same as depreciation. It's the allocation of the cost to expense. Remember, for plant asset, building equipment, we use the term depreciation, which is a cost allocation process. For natural resources, we use the term depletion, the allocation of the cost in a rational and systematic manner. Okay? Companies generally use something called units of activities, and depletion is generally a function of the units extracted. Because it's easy. Why? Because if you're extracting oil, you pay something. Let's assume you paid, let's look at an example. Let's assume you paid $5 million to buy an oil well in Texas. And minus the salvage value is 0. Let's assume you can extract, I don't know, this is per ton, so I don't know, gold, mineral, whatever, but let's assume it's oil. And let's assume you could extract, I can change this, 1 million barrels. So if you take the cost of 5 million divided by 1 million barrels, and how do you know it's 1 million barrel? You just estimate it. So it's 1 million barrel. So how do you deplete? Okay, you deplete your cost at $5 per oil barrel. So let's take a look at this. Actually, local coal company invests $5 million in a mine estimating to have a 1 million ton of coal. So this is not oil, this is coal. So they invested 5 million, there is no salvage value, and they're going to extract 1 million of coal. Therefore, the depletion base is $5 per ton. So every ton we extract from coal, it's going to be $5 per ton. So let's take a look at this example. So in the first year, we extracted 250,000 ton. Well, so if we extracted 250,000 ton, we'll take 250,000 multiplied by 5, and our annual depreciation is 1,250,000. What's the entry? We debit inventory of coal. Why? Because we extracted the inventory. Now we have inventory of coal, 1,250,000, and we credit accumulated depletion. Now, you might see in different textbook. In your textbook, they might say you debit depletion expense. It all depends on, this is why this is a topic a little bit beyond the scope of the course. It all depends on what's going to happen with that coal. Is there an available market for it? Are you going to sell it immediately? Are you going to expense it? In other words, you're going to debit expense and at the same time sell that coal to someone. Is there a readily available market? Or you might have to hold on that coal, who knows, maybe 6 months, maybe a year until you sell it, then it's inventory. So it all depends on what happened to that coal. For our purposes, we debited inventory. We debited an asset. Then when you sell the coal, you credit so let's assume we sold the coal for 1.7 million. So we debit account receivable, credit sales, 1.7 million. Then we debit cost of goods sold, 1,250,000, and we credit inventory, 1,250,000. And this is when we get rid of the inventory. This is assuming we had to hold the coal until we sold it. But in some textbook, they debit depletion expense. And the assumption is if you debit depletion expense, it means you basically, the revenue is being generated immediately. Basically, in other words, there's a readily available market. And in most textbook, they debit depletion expense. So this is a little bit unusual, but again, we don't want to go into this explanation because it's beyond the scope of the course. Go to my intermediate accounting if you want more information. Make sure to read the book. Make sure to know what depletion is. Make sure to know what natural resource is. And this is units of production. Basically, we are depleting the coal, the mine based on the production, based on the output. If you're studying for your CPA, if you're studying for your CMA exam, make sure to study hard. It's worth it.